Our last video content in Module 4 is a bit of a mishmash of international topics. And so video T13D skips around a bit. Here we go. The first part of this video is devoted to understanding some of the unique entity choices that can be made with respect to an international operation by a U.S. business. We're going to examine structures that include a branch, a domestic subsidiary, and a foreign subsidiary. A branch is the easiest to accomplish because generally the business isn't setting up a new entity. Instead, they're just setting up an office or division or simply putting some employees overseas. Often the only filing requirements are on the part of the foreign jurisdiction. For example, registering to do business in that country. Because there's no separate entity, losses flow right into the U.S. company. Any foreign income taxes paid by the branch are creditable as a foreign tax credit, and that reduces double taxation. And the branch is eligible for tax treaty benefits, and more on this later. Branches are a low-cost way to enter a foreign jurisdiction to see whether a larger operation might be feasible for the future. As the business continues to grow, often the U.S. parent will establish a domestic subsidiary to hold the branch. This is done for a couple reasons, one of which is, of course, it provides a liability shield to the U.S. parent for anything that might go wrong under foreign law. There's a pretty good chance that the domestic sub remains a part of the consolidated tax return, so again, income and loss flows right through to the parent. If the business continues to grow, then often a foreign subsidiary will be organized. This is done for a number of reasons, one of which is often that local law may require it, or foreign creditors may be unwilling to contract with a U.S. company. From a tax perspective, the deferral of earnings is on, and with the new territorial system, repatriation of the foreign income will enjoy a dividends received deduction. So moving on to a new topic. Certain types of income are easy to move around the globe. For example, it would be easy to organize a CFC in Grand Cayman, my favorite, and place all the cash and investments in that sub, and therefore shelter that income from U.S. taxation. However, the rules introduce something known as Subpart F. Subpart F was invented in the 1960s, and what is unique about Subpart F income is that it is taxable in the U.S. whether it is repatriated or not. It's another anti-deferral provision in the U.S. tax code. Our next topic is about transfer pricing. When all of these foreign subs we have set up all around the globe sell half-made products to one another, because they're related parties, there's an opportunity to, of course, set prices of inventory sales between the related companies at amounts that shift the income to lower tax jurisdictions. Obviously, taxpayers left to their own accord would charge prices to themselves that minimize taxes. In this example, the intercompany transfers between the Malaysian sub and the Indian sub would be set to shift income into the lower tax jurisdiction. The US, and frankly most other countries, require transfer pricing between related parties to be at fair market value. In the U.S., the IRS wields significant power to reprice in situations when market value has not been used. And for our last mini topic, tax treaties. These are bilateral agreements between countries designed to permit businesses to operate with less tax complexity and to reduce double taxation. For example, if Steve, a U.S. citizen, owns some UK stocks that pay dividends, then Steve is taxed on those dividends in the UK. However, Steve has never been to the UK and has no property there other than stocks. The UK, like most governments, knows that people like Steve are a risk to never pay their taxes in the UK. And there would be little that the UK government could do. One strategy for battling Steve's temptation to not pay his UK income tax is to impose a withholding tax on the dividend payer. For example, maybe the UK requires payments to non-residents to have 25% withheld to cover taxes. One of the common provisions in a tax treaty is to lower the withholding rates to permit Steve to pay something closer to his actual UK income tax rate. And the same is true of UK residents and US withholding. That is the end of video T13D. Only a Module 4 summary to go. Thanks for watching.